and welcome to Freedom Federal Credit Union's financial seminar on home buying and mortgage financing basics. We're so glad that you could join us today, and I just wanted to go over a couple of basic housekeeping rules for our virtual meeting. First of all, welcome, and we are so glad to see you. We'll help you get great benefit from this hour that we're going to spend together. During the presentation, we will have you muted, and if we don't have you muted, we ask you to mute yourself because we're expecting 30 or 40 people to come on board, and it can be distracting if people have their microphones left on. So please mute yourself and sit back and relax, grab a cup of coffee, and get ready to learn everything you've ever wanted to know about home buying and mortgage basics. So with that, if you do have a question, please submit it in the chat box. We will have Q&A time in this presentation, but we'll also try to look for questions as we move along, and we welcome your interaction through the chat box with any questions you have of the moment. We'll watch for those. And with that, I think we'll begin. Good morning, everyone. Still morning, and this is Sue Manning. I'm the Director of Business Development for Freedom Federal Credit Union. I just wanted to give you a brief overview of Freedom and a little bit about what's going on with us. I'm kind of curious. I see we have over 30 people now, and I wonder if I'm wondering if you are a member of Freedom or if you are new to Freedom. So if you could, in the chat box, and this is a good practice for when you're ready to ask your questions, just give us a chat and let us know if you're a member or a non-member. All are welcome, and we're very excited to see everybody. And so for those of you who are not members or maybe don't know as much about Freedom as you would like, Freedom is a credit union, which is very different from a bank. We are a not-for-profit organization, and our primary concern is the welfare and benefits of our members, not shareholders and those who are looking to profit from investment into a commercial bank. So you'll have a very different experience when you work with a credit union. You're also going to find that one of our #1 goals is to contribute to our community and to the well-being of our community. This is why we have financial seminars like this and reach out to you and help to bring knowledge and help you to prosper and do well throughout your financial lifetime. When you join Freedom, you are an owner, a member owner of the credit union. And credit unions give us a great advantage of being able to pull together as a group and provide our own financial needs so we don't have to rely on commercial banks. Let's go on to the next slide. There's some wonderful things about Freedom. And of course, you can bank with us with great confidence. All of your deposits are insured. And we have a fabulous high yield checking option. So if you've been looking for a place where you can keep your money safely and earn 3% every month on your balance up to $10,000, consider a high yield checking with Freedom. We're always going to be here for you for low interest loans, debt consolidation, and of course today we're going to be talking about home buying options and ways you can save money there. We're small enough to give you personalized service, but we offer great technology, just like you'd see at any large bank. So you have your online banking, bill pay, remote deposit capture, thousands and thousands of ATMs across the country, and just great technology at your fingertips. Finally, we do believe in financial education. We make a great investment in that, and we have wonderful online tools for you to continue and explore other topics whenever you are ready at your convenience. Just visit our website. Next page. So 2020, to say the least, has been a crazy year for all of us. And in 2020, Freedom came to realize that we were essential workers. And so we remained open throughout 2020 and on through 2021. We expanded our operations to meet your needs. We reached out to the community for emergency assistance to our members, and we expanded and refined our many loan options to help those who needed help the most. And I'm really proud that Freedom continued with all of our community support and outreach. Everything that we planned to do, we persevered and we did in 2020. We didn't let the pandemic stand in our way. And the picture you see in the right-hand corner is us delivering thousands of masks to Harford County Public Schools for the school teachers. Something that I was very proud of and so happy to see us be able to do that. Next page. So our big news in 2020 is that we expanded our ability to serve and support our members, and we're moving into Baltimore County. This is going to expand and allow us to grow and be able to send our special credit union services to folks in a broader area. So if you have friends, family down in Baltimore County, let them know that Freedom is here, and we are here as a chartered credit union now in both Harford County, where we've been for 67 years, and now to Baltimore County. So full steam ahead. If you are not a member and are interested in becoming one, I would love to help you with that. You could also go online and visit Freedom anytime and join conveniently online, or make an appointment to stop into one of our convenient branches and deal with us person to person. We welcome you. So I'd like to just introduce my colleague, Mike OSTROWSKI. Mike is our guest speaker today, and Mike is a longtime member of Freedom and a wonderful resource, a great professional, and someone that I think you'll enjoy getting to know and getting his advice and the information that he's about to share with you. So as I said, grab your cup of coffee, relax, meet Mike OSTROWSKI.
Good morning, everybody, and thanks for taking time this morning to be with us. As Sue said, I've long-time member and been in the industry for a long time, so I'm not sure if that makes me an expert or just old by default. In any event, I've been in the real estate industry since 1978 and have been in the mortgage business since 1991. And what we're going to talk about today basically are financing basics, those things that have held true since 1978 and still hold true today. If you're thinking about becoming a homeowner and purchasing real estate, what we're going to talk about, as I said, is just as true back in 1978 as it is today. Coming out of 2020 with the pandemic, it's created challenges for folks, economically, personally, and certainly within the housing market. And one of the things that we've noticed has been with the drop in interest rates during the pandemic, housing has become more affordable, if you will. And a reaction to that has been a huge interest from folks wanting to buy, first-time buyers as well as move-up buyers. Money's cheap right now, and so the interest is there to move forward. And so what I'd like to do is set the stage for what you need to get in place to be part of that real estate environment and get yourself ready to go ahead and purchase. So if we go to the next slide, please. So these are the basics of what you really need to know, and these four items really haven't changed over the years. They've maintained their importance. That is the 4 C's of underwriting. When we're looking to approve you for a loan, we have to look at these 4 items: the collateral, capacity, credit, and capital. And you have to meet the criteria for each one of these in order for a loan to be approved. The collateral is the property that you're looking to purchase. That is what secures the loan for the lender. Heaven forbid something should happen and the borrower is not able to make the payments. How are we going to recover our money? How are we going to recover that loan? Well, the way that happens is by putting the house up for sale, and hopefully in that process there'll be enough funds to make the lender whole and pay off that mortgage. So one of the things that we look at is collateral. How much is the house worth? What's the marketability of the house? Is it going to be enough to secure the loan that you're asking for, or the borrower's asking for? Over the years, what I will say is these 4 items, the dynamics of these 4 items have changed in importance or challenges over the years. For example, with collateral, after the housing crisis in 2008, collateral became a big issue. Homes lost value rapidly, and that became a concern when we were looking to to lend in that environment. That has now righted itself, and we're actually in the far opposite position right now, where collateral homes are appreciating in value like we haven't seen in some time. So that's a good thing. Property values are increasing. So the collateral has righted itself. Capacity, that's your ability to repay the loan. That is where, what is your income versus your debt load? And one of the calculations that we do as a lender is what's called a debt to income ratio. What is your monthly income and what are your monthly debts? And what is the ratio of those two to each other? Again, over the years, the capacity, those debt to income ratios, at sometimes, they were a challenge for folks. At other times, and the environment we're in right now, it's not so much of a challenge. The debt to income ratios seem easier to achieve than they had been at previous periods. Those ratios, for example, in today's environment, we look at your income versus the debts. We don't want the debts or your monthly obligations to be more than 43% of your gross monthly income. And by gross, we're talking about your income before taxes. So, that's the basic ratio that lenders are looking at these days. When I started in the industry, that ratio was at 28%. So what that means is over time, the different loan programs that are out there have become a little bit more lenient or liberal, if you will, in how much debt you can carry versus your income. And if you take that a step farther, that means that home ownership was opened up to far more people than it had been. When you're at a 28% debt to income ratio, that's restrictive. When you get to 43%, it opens up the market to more potential home buying opportunities. On number 3, credit, the willingness to, what we look at is on the credit history, that's the best example we have of how are you expected to pay your new debt that you're incurring with this mortgage. Well, the credit history tells us your willingness to repay those debts. Credit has always been very important. One of the major things within the 4 C's of underwriting, credit is probably the far most important. It can stop an application in its tracks, or it can make it sail through very smoothly. Again, as with collateral and capacity, we've seen changes in folks' credit histories, good, bad, or indifferent, and it's changed with the markets. There were times where credit was the biggest challenge that we had in trying to get somebody approved, and it seems like probably within the last maybe 10 to 15 years, that's sort of righted itself a little bit, and it might be through education programs that are out there or more consumer awareness of just how important credit is. It's become less of a challenge than it had been in the past. And part of that may be because credit is now scored. There's a number that's attached to your credit history, whereas in the past, there were no scores, and it was simply an underwriter's opinion of what they felt about your ability to repay this future debt. And I can tell you, when I started in the industry, we had 3 underwriters in our department. And if you had a credit package that was a little iffy, there was one underwriter we didn't want that package to go to because she was very, very tough on credit and analyzing credit reports. And we knew if it was marginal, she was going to rule on the side of extreme caution and not approve those types of loans. That's all been taken away with credit scoring. So a base number is set, a minimum qualifying number is set for the credit. If you meet that number, then from a credit standpoint, the loan's pretty much approvable. The 4th item, capital. How much money do you have to work with to get through the transaction? And again, during certain periods of our economy, that was a huge, huge issue. Folks didn't have 20% to put down. And besides the 20%, you also have to budget for closing costs. How much is it going to cost to get through the transaction? So you have to make a down payment, and then you have to account for charges from the lender, the state, the county, and the title company. They all are involved in that whole nut, if you will, of cash to get through the transaction. So for a period of time, capital was one of the major issues that we had to deal with. That has sort of gone away a little bit, and folks seem to be a little bit in a better position for what they can do. And also there are some loan programs out there where you can minimize the amount that you need to get into a property these days. You don't have to have 20% any longer. Okay, next slide, please. So one of the first things that's going to happen if you're getting ready to go out into the real estate market, when you talk to a real estate agent, they're going to ask you if you've been pre-qualified by a lender. Now, back in the 80s, when I was a real estate agent, pre-qualified was not even in the language. That didn't exist. We put people in our car, took them to a neighborhood that they were interested in, found a house they liked, we wrote an offer, and then for the next 60 days, we were sweating bullets, hoping that everything was going to work out and the loan was going to go through and we could get the settlement. Well, the industry finally got smart and realized the better way to do this is to figure out what the borrower can do in terms of being approved for a purchase price and a loan, as opposed to waiting to find out after they've entered into a contract. So as the market is today, an agent won't take you out in most cases to even look at property until you can present them with a pre-qualification letter from a lender. The benefit of this is, number one, if there are any credit issues, it's going to bring those up very early in the process. So, what do we have to work with or work toward in order to get these credit issues taken care of, and how much time is that going to take? So the pre-qualification process can set that stage and make the eventual buying process a much smoother process to get through with less stress. It also talks about how much cash you're going to need. If you've earmarked, I want to purchase a $300,000 home, well, we can tell you, here's how much cash is going to be expected to come from your side of the transaction table for down payment and closing costs. Do you have that much cash to work with? If not, okay, there are some options we have here. Foremost is gift funds from a relative, where they basically give you money to get you through the transaction. And that is an acceptable source of closing costs and down payment money. How much house can you afford? That's basically what the pre-qualification process is all about. How much can you afford? No sense in going out looking at a $500,000 community if your qualification is $200,000, and vice versa. If you're asking for $200,000 and you find out, well, we can afford $500,000, then maybe your sights are set on something around $300,000 or $350,000, that midpoint, more than what you thought you could afford. It also will tell you what your monthly mortgage payment is going to be, which is very important for budgeting purposes for yourself. I've been in a number of cases where I've done a pre-qualification for somebody and told them, here's what you can afford, only to have them come back and say, well, that's much more than I want to spend on a monthly basis. We were thinking we'd like our payment to be X. And so then we back into, all right, if your payment is X, here's what the purchase price is going to be. Here's what the loan amount is going to be to get you to that X number for your budgeting purposes. And that's a nice conversation to have with somebody when they've budgeted a certain amount. So, here's what they're comfortable with, as opposed to telling them, here's what the payment's going to be. And then they're sort of backing off because that doesn't fit what they had in their mind as a potential payment. So very important to get pre-qualified to get started. And here at Freedom, that's a no charge process. We don't charge for the pre-qualification. We simply ask you to fill out a form, provide some documentation, and then within 24 hours, we're back to you with a response on what you can do in terms of your home buying potential. There are a ton of different mortgage programs that are out there. And so starting with the very basics, which one's going to be right for you? Well, my answer has been for years, it depends. I call it my attorney's answer. I'm non-committal. Well, it depends. Well, it depends on you, your financial situation, and your comfort level. We have 38 folks in the seminar this morning, and I guarantee you that if I went through and did a pre-qualification for each and every one of you, we'd come up with potentially 38 different purchase prices, loan amounts, and variations on these programs, because your finances are different from everybody else's, and your what I'll call risk tolerance is going to be different from other folks. What am I comfortable with? What am I comfortable with obligating myself on a monthly basis as far as that mortgage payment? So the first thing that lenders like to talk about are fixed rate versus adjustable loans. A fixed rate loan is just that. The rate is fixed for the entire term of the loan. If you're doing a 30-year loan, whatever that rate is going to be the same rate for that entire 30 years. Your principal and interest payment of the mortgage will stay that same level for the 30 years. The only thing that might change would be if your real estate taxes go up and your homeowner's insurance were to change. That could change the total monthly obligation, but the principal and interest portion will stay the same. The adjustable rate is just what it says. That rate is not fixed. It can adjust at some point in the future. And I can tell you, after 30 some years of being in this business, rates will change. I get that question from folks when rates are, especially when rates are coming down. Do you think I should wait? Well, what's going to happen to rates? Well, I can guarantee you rates are going to change. When and by how much? Don't know, but they are going to change. So why would we recommend a fixed rate versus an adjustable rate? Well, how long are you planning on staying on the home? My first experience with this conversation was with a gentleman that worked for Black & Decker years ago, and he was a regional director for them, and he used to get transferred throughout the United States every 3 to 5 years. So he knew that in 3 to 5 years, he'd be out of that house. And Black & Decker used to buy the house from the employees. That was part of the program that they had with them. So in talking to him, it made sense for him to do an adjustable rate. And we put him into a 3-year adjustable. So it was fixed for the first 3 years and then could adjust after that. So he was very comfortable with the fact that he was getting a good rate, because adjustable rates historically tend to be lower than the fixed rates. And he knew that in 3 to 5 years, he'd be out of that house. So even if the rates did adjust, it wasn't going to have a huge impact on him, and he'd be gone and on to his next property. Other folks, historically, 7 years is the time that we stay in our first home before we then sell and move on to something else. So a fixed rate may make more sense for that, where you're getting in, you're able to budget each month, and you don't have to worry about any potential increases down the road. Also talk about a little bit when we're trying to recommend one over the other, anticipated changes of income. Best example I can give of this would be someone in the medical profession, a doctor doing their residency, and their income in residency is not going to be as great as when they go into private practice. So maybe an adjustable rate works for them because they know their income is going to dramatically increase in 3 to 4 years, and they can handle any increase that there would be in the mortgage payment. So again, if you start picking up on this, it depends on the situation. And what happens if interest rates change? Well, with a fixed rate, it doesn't matter. You're locked in, your rate is your rate, and you move on. If rates increase, you're protected at your fixed rate. If they decrease, then maybe it makes sense to refinance that mortgage into the lower rates. And that's a whole nother conversation and a whole nother presentation, but you do have that option to always look at refinancing if rates do drop. With the adjustable rate, well, it can adjust up and down. So if rates were to increase, you could have an increase in your rate. There are caps, limits that are placed on that, and they can only adjust to a certain degree. You can also adjust downward too. So in a downtrending market like we've had over the past year, if you had an adjustable rate, you may see that rate decrease over time and your payment adjust downward. So again, do we do fixed or adjustable? It depends. In today's market, fixed rates are so low, they're at the level of adjustables. So it just doesn't make sense in this market to look at adjustable rates. You're much better off looking at that fixed rate option because they are so low. Right now, a 30-year mortgage is at 2.875, below 3%. It's extremely, extremely low. Government versus conventional loans. One of the best programs that's out there, if you qualify for it, is the Veterans Administration or VA loan. You have to be active military, veteran, retired military, or surviving spouse of a deceased veteran. That program allows for no down payment from the veteran, 100% financing, allows the seller to pay all of the veteran's closing costs. So in theory, the veteran could get into the property for just the cost of the appraisal and homeowner's insurance. Great program out there. But if you're not a veteran, what do we do? Well, there are other options out there. FHA became a very popular option. Back in the day, conventional loans required a 20% down payment. If you didn't have 20% down, you weren't doing a conventional loan. So you weren't a veteran, you had to do FHA. And FHA became hugely popular, especially with first-time buyers, because they didn't have 20% to put down. That's changed over the years. Conventional loans now, some programs out there allow you to put as little as 3% down on the conventional side. FHA, back in the day, they required 5% down. Now that's been adjusted to 3.5% down. So a very popular program. Still continues to be popular, but not as much. And I'll get into that in a little bit as to why the popularity for FHA has dropped off a little bit. With the USDA, depending upon where you're purchasing, it's really designed for rural areas. So if you're in a rural area looking to purchase, this might be an option for you, and has some nice benefits as well with little to no down payment. So again, it depends. Which program is going to be best for you? It depends on your personal situation, and that's where a lender can sit down and counsel you as to what the options are and which one's going to work best for you and which one you're comfortable with.
Mike, we do have a question.
Yes.
Tamara, she's asking if you're heading into retirement and looking as fixed rate being a beneficial, retirement, that income changes, or you work with many people.
And again, I would say if you're looking to retire soon, within the next year to 2 years, the fixed rate absolutely would be the best way to go right now because rates are so low. So that just on the surface of it, that would be the recommendation, would be to go with the fixed rate.
Thanks, Mike.
Mm-hmm. Okay, next slide. Okay, so I don't have 20% to put down, and a lot of folks didn't and still don't have 20% to put down. So what do? Well, it requires mortgage insurance to be carried on that loan. Now, folks, mortgage insurance does not protect the borrower. When I have initial conversations with folks, they think this mortgage insurance is protecting them. It doesn't. There's no benefit to the borrower whatsoever. This is a lender protection insurance. It protects the lender in the event the borrower defaults. The lender puts the house up for sale and there's not enough net from the sale of that property to pay off the mortgage. The lender will then file a claim with the mortgage insurance company for any amounts they have lost in that process. So again, be very clear here and understand the mortgage insurance benefits the lender, not the borrower, and only benefits the lender in the event of default. So anytime you're not putting 20% down, mortgage insurance is required, and it's paid for by the borrower. How do we pay for it? How do you pay for it? Well, either through an upfront premium or through monthly premiums or through a higher interest rate. There's a number of different ways that that's achieved depending upon the program and lender that you're talking to. The other thing about mortgage insurance too, there was talk about changing this, but it's never come to be, and that was mortgage insurance is not tax deductible. So you really get no benefit. It's a built-in expense in your monthly payment. You'll see a separate line item on the breakdown of your monthly mortgage payment, mortgage insurance, $150. And that doesn't protect Mike OSTROWSKI from anything. And I paid each month and I get no benefit. So just be aware that when you see mortgage insurance, that's protecting the lender.
And Mike, we have a question.
Yes.
On mortgage insurance. Does mortgage insurance go away once you get to that 80% mark? And if it does, why would you do the upfront premium?
Right. So get back to my previous answer on the previous slide. It depends. It depends on the loan program as to whether or not the mortgage insurance will go away when you have 20% equity. Just to give you an example, FHA used to have that ability for the mortgage insurance to drop off when you got to 20% equity in the property. You would have to have the property appraised to prove to the lender that you had that equity, but yes, it could be dropped. However, in 2015, FHA stopped that policy. And FHA now has a policy of life of loan mortgage insurance. So as long as you have that FHA mortgage, you're going to pay that FHA mortgage insurance on a monthly basis. So again, it depends. Conventional programs, when you get to the 20%, yes, you can request that the mortgage insurance be dropped. Again, they're going to ask for an appraisal to be done, and then that will determine exactly how much equity you have in the property. So again, In essence, it used to be that all programs offer that. Now, not so much. So that's where, again, depending upon the loan program you go into, will determine whether or not the mortgage insurance can be dropped. That's also one of the reasons why FHA since 2015 has dropped off in popularity, because there are other options out there that will allow you to drop the mortgage insurance once you get enough equity. Okay, next slide. Okay, how do we avoid mortgage insurance? Well, the easiest, neatest, cleanest way is I put 20% down, I don't have to worry about it. Not everybody has 20% to put down. The other option is, if you don't want to pay the mortgage insurance, we offer, and we're one of the few lenders that offer this. It was very popular for a period of time in the early 2000s after the mortgage crisis. Number two, option two here, pretty much went away. We're one of maybe 2 or 3 lenders that I'm aware of that even offer this. And that's where we offer you a second mortgage on the home. So you do your first mortgage for 80% of the value of the property. So to keep it simple in my mind, I'm buying a $100,000 home. I'll put down theoretically 20%. So I'm going to finance 80% or $80,000 of that purchase price. The requirements for mortgage insurance are, how much are you borrowing on your first mortgage? Answer is 80%. The result is I don't need mortgage insurance. However, I don't have 20% to put down. So I then take out a second mortgage for the remaining down payment that's required. We will accept a second mortgage at 15% of the value of the property, meaning 80% for your first mortgage, 15% for the second. You're borrowing 95% of the value of the property. That's going to be your mortgage, and you put 5% down. So you've just avoided having to put 20% down. You only have to put 5% down, and you've avoided the mortgage insurance. When I've done the analysis for borrowers comparing FHA specifically versus doing a first and second mortgage, we always come out with a lower monthly payment, even though we have 2 mortgages. So again, lower monthly payment. Add the payment for the 80% first mortgage, add the payment for the 15% second mortgage, and it comes out less than the payment for FHA, where you're putting less money down. It's become popular. One thing I have noticed, and this is, us being human beings, you talk to people and they say, well, we'll do a first mortgage and a second mortgage. And immediately they back up. Oh, I don't want 2 mortgages on my house. Okay, let the numbers be your response and direct you. Emotionally, I don't want to owe 2 mortgages. Well, if you don't have 20% to put down, you don't buy the house. If you do 2 mortgages, you can buy the house. You wind up with a lower payment. And oh, by the way, that second mortgage, the interest on that under today's laws, tax laws, is tax deductible. The mortgage insurance is not. So when we run the analysis, and we always leave it up to the borrower, here's what FHA will do for you. Here's what our program of a first and second mortgage will do for you. What are you comfortable with? It's your decision to make. You're the one that's obligating yourself to the mortgage, not us. So you tell us what you want to do. And in most cases, after people see the numbers, they'll say, it does make sense. Yeah, I understand now how I can get a lower monthly payment without having to put 20% down and running into the mortgage insurance through the FHA program. So even though you hear 2 separate mortgages, it's not necessarily a bad thing. You have to look at the numbers and make your decision based on that. Okay, next slide. So the application process, and this has remained pretty constant through the years, really hasn't changed much. We need pay stubs covering the most 30 days, and W-2s for the last 2 years if you're a W-2 employee. If you're self-employed, then it's the federal, and I stress here, only the federal return. We don't need the state, just the federal return for the last 2 years, along with, if you're a 1099 employee. When I was a real estate agent, I was a 1099 employee. I didn't have W-2s. So I would have to provide my tax returns for 2 years along with the 1099 statement. If you're receiving a pension or Social Security, then we need a statement from that program showing what those benefits are, either on an annual basis or a monthly basis. And then your bank and credit union account statements covering the most recent 90 days. Now, one thing I would say here is it's not a bad thing to start collecting these items today. If you're going to be in the housing market even 6 months from now, it's not a bad thing to get started and start collecting these. With the bank statements, well, they're going to get stale after, a couple days or a couple months, I'm sorry, because you're looking at the most recent 90 days. So as you get a new statement in, discard, the oldest statement that you have and just keep that file going until you're ready to move forward and get pre-qualified and start the actual process. If you have IRAs or 401ks or CDs, you want to keep those statements, and those are usually quarterly statements. So what we're looking for there is the most recent quarterly statement that you have. One thing I can stress, folks, on the bank statements and the other account statements is please keep all pages, because we have to see all pages. So if you have a 10-page account, we need to see pages 1 through 10. Oftentimes people will just give us the summary page and assume that's all we need to see, and we don't. We have to have the entire account. It has to have your name on the account, and it has to have the financial institution's name on the account so we can link it to a particular institution and link it to you as the borrower. We need to know that these are your funds that are going to be used for the transaction. Just going to mention this real quickly. With the pandemic, there have been some economic hardships for folks where income is not as great as it was prior to the pandemic. And now that things are starting to open up a little bit more, hopefully that income comes back. We do not here at the credit union sell our loans in what's called the secondary market. Not to get too complicated here or technical, we keep everything right here at the credit union. So when we underwrite the loans, we're looking at it from what I call a common sense perspective. Tell me your story. If it makes sense and it's reasonable and it's going to fit the guidelines, I'm not going to penalize you for a pandemic that occurred. I'll work with you. If we can't do something today because of the economic situation, I'll certainly give you a time frame and options for the future. We hate saying no. We'd rather give you options and advice moving forward. Okay, next slide.
So Mike, before you move to the next slide, we have a couple of questions.
Okay.
And one is back to, avoiding PMI.
Mm-hmm.
The question is, do you pay the same interest rate for the first and second mortgages? And what is typically the term of that second mortgage?
Good question. The interest rates typically are different for the first and second mortgage. And again, it depends on the type of second mortgage we're doing. We have fixed rate options and we have adjustable rate options. So it depends again on what you're comfortable with and where that payment's going to fall out. So the interest rates are different and the terms can be the same or they can be different. Again, it depends on which option is looked at. On the fixed rate options, we offer terms of 5, 7, 10, 15, and 20 years. On the adjustable rate option, it's a 15-year term, 15-year payback.
Thanks, Mike. That's helpful. And someone wants to know if you, let's say you're buying a home for $250,000, but you were approved for $300,000 on that home. So you've got, I guess, some equity there. Can that $50,000 be used towards a down payment or credit?
No, not during the purchasing process. That would come into play after you own the home and you were potentially looking at doing a home equity loan or some type of home improvement loan, or looking to refinance down the road and take cash out. But during the actual acquisition of the property, congratulations, you got a great deal, but no, the equity can't be used.
And then one more quick one. If a person has 2 jobs and one is part-time, do you have to submit all W-2s for both jobs if you're not really wanting that job to be considered in the application process?
If you're not wanting a job to be considered, no, you don't have to submit those W-2s.
But if you do wind up needing that income to qualify, then you
Yes. Yeah, if it's going to be used in the process, then we have to see the supporting documentation. And on part-time employment, we want to see a 2-year history of that. That's the preferred.
Thanks, Mike.
Mm-hmm. So again, with the application process, required verification, we have to verify your employment, the rent, or mortgage. If you had a house and you're buying another one, large deposits. We're not as strict on large deposits as a lot of lenders. What I call the big box lenders, the Bank of America and Wells Fargo and those folks. they are very, very tight on their restrictions about large deposits. They want to know where every penny came from. We're more concerned with the big picture of, do you have the cash to get through the transaction? Not necessarily where the funds come from, unless you've borrowed them, and then we need to know what the payment is on those borrowed funds, so we can include that within the debt to income calculation. Recent credit inquiries, it's fine to shop around and talk to different lenders, but do that prudently. You don't want to be talking to every lender on the internet, because they have the potential to pull credit if you do that, and that could cause problems down the road. And the source of gift funds, our only restriction on that is it has to come from a family member. We don't want it coming from the seller. That's considered a financial inducement to buy the property, and that's a no-no. So, we want funds coming from a family member. One thing I will tell you
really
about,
great questions. This one, if someone's recently changed jobs and went to a commission job, and so of course it takes a while probably to build those commissions, how long should I wait before looking to get a new mortgage, or should I wait?
most lenders are going to require on commission a 2-year history of commission income. And let me clarify for you, when I say 2 years of commission income, it's going to be 2 tax returns showing commission income. Because what we have to do with commission income is we have to average it, because it's not going to be the same from year to year. So that's why lenders require 2 years on that. So going to commission income is fine. I was commissioned for a lot of years when I was a real estate agent, but you've got to have a 2-year history to prove a stability of income. Getting back to the required verification, what I like to tell people is we have to verify everything you tell us. If you tell me the sun rose this morning, I'm going to believe you, but I'm also going to ask you to provide me with a picture that's been notarized and certified by Bob Turk that the sun did rise this morning and the exact time that it rose. So whatever documentation you give us, as long as we can verify it, then we can use it. If we can't verify it, we can't use it. And I'll throw this out there. I frequently get, I do side jobs. I'm a mechanic, and, I've got people lined up on Saturday mornings that want me to do side jobs for them, and I do it, and I take cash for it. And I'm making about, a third of my income at the dealership. About a third of that income is also being paid to me under the table by, neighbors, friends, family members, whatever. We can't verify that. So there's no way we can use that cash income, unless you're reporting on your tax returns. Okay, next slide. The do's and don'ts. So we'll put together a couple of things that we want you to do to help in the process from pre-qualification all the way through settlement. Keep originals of your pay stubs, bank statements, and other important financial documentation. As I said earlier, this, if you're going to get into the house buying process, you'll want to start getting this documentation together now. As it gets dated, you certainly can replace it with updated financial information, but it's not a bad idea to start now. I can tell you, I've got 3 applications sitting in my office here with me. And I'm just waiting on documentation from the borrowers. I can't do a thing with them because I don't have a complete loan package. And so that just, it adds to a backlog of loans that we want to get through the process, and we want to meet deadlines and keep everybody happy. It really and truly does start up front with the documentation we get in. So I can't stress that enough, getting your documentation together and keeping the originals. Do notify your loan officer if you plan to receive gift funds for closing costs. And the reason for that is there's a form that has to be filled out. It's a gift certification form, and it's a 1-page form, very easy to fill out. It simply asks who the donor is of the funds, their relationship to you as the borrower, and that it is a gift with no repayment plan, formal repayment plan or structure to the funds, and that it is to be used for the purchase of your property. It's signed by both parties, dated, and that's it. Okay. The question just came about, going from a W-2 to commission. Notify your loan officer of any employment changes, such as promotion, transfer, or anything regarding your payment structure. Many years ago, we had a gentleman that, quote, went on sabbatical from his job. And we found out 2 weeks before settlement, and caused a lot of stress for a lot of folks, the sellers, the agents, myself. So had that borrower been upfront with us about what was going on with their job, we would have been able to advise him as to how to handle that situation and, you know, reduce the stress for himself and everybody else involved in the transaction. So the worst thing you can do is try and hide things from us and not, you know, be forthcoming. We're eventually going to find out somewhere in that process. So it's best to know it up front so we know how to plan and what options we have to address. So anything's going to happen to your employment, you know, hopefully it'll be on the positive side. You know, promotions are great. You know, pay increases are great. Those are happy events, and that only makes the situation easier for everybody. So, you know, open and honest on both sides of the table. You know, please respond to any requests that we may have for additional documentation. One of the things that I will tell you here at Freedom, and I worked in the big bank world for a lot of years and came here to Freedom and just absolutely love it here. I feel like I've landed in Oz. It's not like any place else I've ever worked. You know, every place else is like Kansas. We tell you up front in the pre-qualification process what we're going to need, not only for pre-qualification, but also when you do find your property. It's a very simple list of documentation. It's not complicated. It's not exhaustive. You know, you're not going to be running around for 40 days trying to find all this documentation. It's, you know, pretty basic documentation that you should have readily available to you. Once we do the pre-qualification, folks, here's where we're different. I'm a loan originator. I process the loan, I underwrite the loan, I fund the loan. In some cases, I close the loan, and in every case, I post-close the loan. So I'm with this loan from beginning to end. So when I sit down and do a pre-qualification for you, I already know your story. Unless something changes, I don't need to hear the story again. I've already given you the options. We've already, you know, formatted a plan on how to move forward. And at that point, the only thing we don't know is the property. Which property you're going to buy, what condition is it going to be in, and what's that final sales price. But everything else regarding you as a borrower, we know up front. So what it does is, and I smile at this because, again, it's different from being out there in Kansas. It tremendously reduces the stress during the transaction. And I can't tell you how many times myself and our other loan officers here, Barbara and Joanne, have gotten the compliments of, boy, this was really easy. This was so stress-free. It was simple. You know, I really didn't have to do too much. And from our standpoint on getting the loan, you really don't once we have that initial conversation and we get the documentation that we need up front. So that's a huge difference for you. And if you've never been through the process before, you don't have the perspective yet. But having been in the industry as long as I have, when you have one person doing all those functions, as opposed to each of those functions being farmed out to a different person in a different city or potentially a different state, depending upon the size of the bank or credit union, it can be frustrating because you don't know what's going on with your loan. You call your loan officer and quite frankly, they don't know what's going on with your loan. They have to track it down as well. It stays right here at Freedom. You know, once you talk to one of us, you've got your contact and we are reachable Monday through Friday to answer any of your questions that you may have. So,
say, Mike, a question about the world of now paperless records. So can folks download their statements and pay stubs from the internet and then email those things to you, or does it have to be actual, like a file with papers inside of it?
they can be downloaded, and we have a lot of folks that do that, and they'll you know, email the documentation right into us. So when we say originals, again, it's got to be, you know, an identifier on that document, the name of the borrower, as well as the name of the institution that the document's coming from. We have to be able to tie the two together and identify it. So, you know, downloads from online sources are fine and acceptable as long as they have those identifiers on there. For some of those documents, you know, especially like if you're downloading a W-2, need to have a Social Security number on there. You know, again, we've got to be able to tie the borrower to that particular document. Okay.
Perfect. Thanks, Mike.
Mm-hmm. Next slide. So the don'ts. The do's are great. The don'ts can kill a transaction. So don't change jobs without inquiring about it. As I said, we had the one gentleman that took a sabbatical from his job. Please don't do that during the process. As much as you may hate your boss, bite your tongue, get through that process, and make sure you have another job to go to, that's going to pay you as much or more, so you don't have to worry about the mortgage payment. So, but if you're in one of those situations where you have no choice and you have to change jobs, please let us know so we can advise as to whether or not that's going to be fine to do that, or if it's going to be a negative impact. Don't make major purchases. I had this happen, and it's happened more than once, where someone gets pre-qualified for a loan. Now, keep in mind, they have not gone out and bought the house yet. They've been pre-qualified. In the house hunting process, because they're looking for a house with a 2-car garage, they went out and they bought a new car to put into the new 2-car garage that they don't have yet. So they make application, and we pull credit again when we're doing the application. And guess what? The car payment that wasn't there during the pre-qualification all of a sudden appeared when we're doing the actual application. And huge problem. Took the debt to income ratio way out of line, and again, added a lot of stress to a process that shouldn't have been as complicated if there had just been some open communication about what they were going to do with their finances. So don't make any major purchases prior to talking to one of us. How's that going to affect my debt to income, and how's that going to affect my ability to buy in the price range that you pre-qualified me for? So don't open or increase any liabilities, including credit cards, signature loans, or other credit lines. That can have, an adverse impact on the debt to income ratios and could cause an issue. Don't open or close any deposit accounts. I guess the best advice with the don'ts is keep the status quo going during this process, because what you have done has gotten you pre-qualified to buy in a certain price range. So don't do anything other than what you've been doing. If you do things to the positive, adding income, adding, assets, that's fine. We don't want to, cause issues, especially with the debt to income, or lose assets and you don't have the funds to get through the transaction. So whatever you've been doing to get yourself to the pre-qualified standpoint in that price range, keep doing that, because that'll get you through the transaction. Okay. All right. I get more questions on this than any other topic. And we could probably do a whole hour just on this, understanding your credit score. Back in the 70s and 80s, there was no such thing as a credit score. And even into the 90s, there was no such thing as a credit score. And I referred to, the one underwriter that we had, Corella underwriter. She was just terrible when it came to credit. It was basically an opinion. We got a credit report back, and it showed an account, showed when it was opened, what the high balance was, what the high credit limit is, how much was currently open on it, and what the history had been, on-time payments or late payments. And depending upon what underwriter was looking at that report, really determined whether or not it was going to be approved or not. And I think this is, one of the nice things that's happened within the lending industry is that they have been able to quantify and put a number based on a history. Okay. So the credit score is a statistically derived number based on the information within a credit file. Now, there are 3 major bureaus that lenders pull from: TransUnion, Experian, and Equifax. Those are the 3 that we pull from, and we get what's called a tri-merged, 3-merged credit report back. So we get information from all 3 bureaus. If your creditor, let's say I have a Macy's card and Macy's only reports to Experian, if I'm just using TransUnion, well, that Macy's information is not going to show up on the TransUnion report, and therefore I'm not going to get the benefit of having a very good payment history with Macy's. So that's why we as a lender pull from the 3 bureaus, because hopefully that way we've captured everything that's out there, good and bad, captured everything, and gives us a complete picture of the credit history for that borrower. So put all that into the mix, and there's a number ranging from 0 to 850. We don't like 0. 850 is, come in and do the loan today because you're going to be approved. And then anywhere in between. With most programs, there's going to be a minimum credit score established for the program. Here at Freedom, our stated minimum is 640. Now, for those of you that have not been through the mortgage process before, if you have two borrowers, there are going to be 6 credit scores that come back because each bureau scores a little bit differently. So TransUnion, Experian, and Equifax score differently. We get 3 sets of numbers from them for borrower A and 3 sets of numbers from borrower B. In the real world, they're going to look at the middle score for borrower A and the middle score for borrower B and use the lowest of those 2 scores as the representative score for the loan program. So if the loan program has a minimum of 640 and one borrower has a 720 and the other borrower has a 610, most lenders are going to go with 610. You don't qualify for the loan. Here at Freedom, we're just the opposite. We use the higher credit score to qualify you for the loan. And that can be a huge difference when folks are looking to get into their first home or even repeat purchases. I like to say we try and find reasons to approve a loan as opposed to find reasons to turn a loan down. We're here to approve loans. We're here to do business with you, keep you happy as a member, not turn people away. So what does the credit score mean to the lender? The higher the credit score, the easier it is going to be to approve the loan. It represents a risk factor, if you will. What's the best indicator of how you're going to pay future bills? It's how you've paid previous bills. And that score tells us, what that tendency is probably going to be to a high degree. And it's proven out over the years. The scores have really been helpful in determining people's success. We don't want people to get into a home and fail as a borrower and a homeowner. We want them to succeed. What does credit score mean to you? Well, what it means to you as a consumer is, do I qualify? Am I going to be able to purchase a home? It's used in so many different aspects of borrowing these days. Automobiles, the interest rate you're going to get on an automobile loan is going to be determined by your credit score. Here at Freedom for our first mortgages, we don't do pricing, what they call risk-based pricing of an interest rate based upon your credit score. If you meet the minimum of 640, you're going to get the same interest rate as somebody who's got an 850 credit score. There's no differentiation between interest rates based on credit score. If you meet the minimum, everybody's going to be offered the same interest rate. Okay.
That's great to know, Mike, because I don't think it's that way everywhere.
It isn't. In fact, the lenders that I've worked for over the years, they actually have about a 3-page spreadsheet, pricing spreadsheet based upon credit scores, loan program, and down payment. And they put all 3 of those factors together. You go across your spreadsheet and you find the rate that's going to apply to that particular borrower. And I can tell you, it's typically not downward adjustments to the rate, it's upward adjustments to the rate as you go across that spreadsheet. So the rate keeps getting higher and higher and higher the more factors you hit as you go across that spreadsheet. We don't do that. It's basically one rate fits all as long as you meet the minimum score. Okay. So what makes up the credit score? I get this question a lot. And why are there, why does each bureau have a different score? You don't see the same score among the 3 bureaus. Well, each bureau, when they develop their models, developed them a little bit differently, tweaked them a little bit differently over time. And so you don't have the same score. They're usually pretty close, but not identical. It's rare when we see, within a point or two. Usually there's about a 5 to 7 point difference, from the highest to the low. So what makes up the credit score is the payment history. How have I paid my debts over time? Have I paid them on time? And have I defaulted on anything? Has anything gone to collections? Do I have judgments? So what's going on with the history? So the history is the biggest thing that makes up the score. Total outstanding debt and available credit. This is important for credit cards. I'm approved for a $10,000 credit card. That's fantastic. That's great. I run out and I start charging stuff and I'm up to my $10,000 limit. Well, guess what? That hurts my credit. When you max out credit cards, that hurts your credit rating. Once you go beyond 50% of your balance to the limit, that starts to ding your credit downward, your credit score downward. So, if you're thinking about home buying, one of the things you want to do a little bit of homework, look at your next credit card statement. What's my balance on that credit card? What's my limit? Is my balance more than 50%? Now I need to start concentrating on maybe getting that balance paid down a little bit to help my credit situation. On a personal note, about 2 weeks ago, I got an offer from a credit card company for a 0% balance transfer for 12 months. I had a balance on one credit card. I just literally transferred that balance over on Friday. And so now I've got 0% interest on that. And I've got a zero balance on the other credit card. And based upon the limit of the card that was offering the transfer offer, I'm well below that 50%. So it works out, excuse me. Sorry about that. So it worked out real well. So again, be mindful of where your balances are versus the limits. The length of time your credit has been established is also an important factor too. You know, someone just coming into the credit world is not going to have that history, and it may be difficult, number one, to get a score because there hasn't been the history there, or the score is going to be not as great as it should be because we don't have as long of a time being in that credit pool. And the type of outstanding debt also impacts. If you already have a mortgage, that carries more weight than will a credit card balance. Mortgage payments versus credit card payments, the mortgage is going to carry more weight than will that revolving debt. Okay, next.
Mike, when you're looking at a balance on the credit cards, is it all your credit cards added together and what you owe on them collectively, or is one credit card maxed out hurt you?
It's going to be the individual credit card. So you want to look at the balances and limits individually. Collectively, that will have the collective impact, but individually they're looked at as well. So you want to make sure that on an individual basis, you're trying to keep those balances down below 50%.
And I just want to tell everyone, hang in there. We know we've just crossed the noon hour, but we're coming into the home stretch. And we do appreciate all your questions.
Okay, understanding your credit score. What's in the credit score? Well, here's what's not in the credit score. Income, employment, age, race, sex, marital status. None of that goes into the credit score. It's all about what have I obligated myself to and how have I made that payment over time. That's what's in the credit score. Okay, next slide. Okay, so what will lower your credit score? Late payments. That's probably the biggest thing. Maxing out your credit cards. We just talked about that. Closing credit cards out. You want to talk to your lender about doing that before you do it, because if you're closing out cards that you have a really good history on, even though you may not use that card frequently or at all, if it's got a really good history, you may want to think twice before you close that out because that could negatively impact you. I touched on briefly about shopping for credit excessively, making a ton of inquiries, trying to find out if you qualify for something or doing interest rate shopping. Be careful about that because that can hurt you. And then opening up numerous new accounts in a short period of time can have the same impact as well. Typically what the lenders like to see and what the credit bureaus like for good solid scoring is about 3 to 5 active trade lines is what they look for. Okay. When we do the pre-qualification, we pull credit. So we see what's out there. So if you have any past due accounts, we tell you to pay those off. If we see balances that are hurting your credit scores, again, the advice is get those down below 50% if you can. Don't close the credit card accounts if you've got a very good, positive, long history with that creditor. Nothing will be a substitute for making payments on time. If you really want to boil it all down to, the essence, a solid payment history where the payments are made on time will help your credit score. As I said, there's just no substitute for making on-time payments. Even if you're only making the minimum payment, that's what's required. You do that, that's going to help you. Okay. All right. Here are the 3 bureaus that most lenders use. Their addresses and contact information. You are entitled to receive 1 free credit report a year from each of these bureaus. I will caution you, they do not provide you with your credit score. If you want a credit score with that, they're going to charge a fee, and each individual bureau charges differently. And so, I would contact them to find out what the most recent charge is if you want to get a score attached to the report they send you. And I will also tell you that what you're going to receive is what's called a consumer credit score, not a lender credit score. They are different. The scoring models are slightly different, and the number that we see on our side is going to be different from the number that you see. It may be better, may be lower, but it's going to be different. Okay. That's all I have. Any other questions? We can wrap up.
While I give folks a second to think about their questions, I do want to let all of you know on the line that we are planning an April financial seminar. It will be on college planning, saving and planning for higher education for your children. And that'll feature guest speaker Rick Fletcher, a certified financial planner from the Kelly Group. So if you or someone you know have children and want them to go to college, this will be a great seminar for them to attend Wednesday, April 21st, and it'll be an evening from 6 to 7 p.m. We do have a question. Do you need to unfreeze your accounts before inquiring about credit?
Yes, and this has become very popular, and we do run into this, especially when we're doing the pre-qualifications. You contact us to have us do the pre-qualification. I would say within 24 hours of us doing the pre-qualification for you, you'd want to contact the credit bureau to have them unfreeze your account so that we can pull credit. We'll let you know once we've pulled credit, and you can certainly put the freeze back on at that point. But yeah, it's the only way that we can look at credit.
And then, Mike, we have a question on refinancing. What happens if someone was in forbearance, a forbearance plan due to COVID?
Right. I can give you the freedom answer. I can't answer for the big bank world. As long as we have documentation that you were in forbearance with the other lender and you weren't just not making the payments, that there was actually the agreement, and you should have something signed from the other lender, we're fine with that. It's not going to have a negative impact on the refinance process. We've had a number of our mortgage customers as well who we've done forbearance with during COVID, and so we fully understand what that means. It's not necessarily a negative thing.
And then, Mike, with freedom, are folks able to pay their own taxes and homeowners insurance?
Yes. One of the things that we do offer with our mortgage programs is we allow the borrower, in fact, we don't escrow, so the borrower is responsible for their own real estate taxes and homeowners insurance. I guess the way I look at it is, why should we as a lender earn money on that aspect of your mortgage payment, let you earn the money, put it into a savings account or checking account that's giving you some benefit, and then you pay the taxes and insurance when they come due.
With the pandemic, does a period of unemployment negatively affect your ability to get a mortgage?
Oh, here we go back to the depends answer again. What we would like to see would be a letter of explanation from the employer that this unemployment period was due to the pandemic. The pandemic's been going on for a year now. And certainly we would not want to see, hopefully wouldn't see somebody out of work for a whole year. So it's going to be on a case-by-case basis, but a letter from the employer would be tremendously helpful to explain the situation. And most importantly, that you are back to work at this point.
Thanks. And then one last question, and I think we're wrapping up. Does Freedom Federal Credit Union have first-time buyer incentives?
We really don't. And when I say we don't, I think what's behind the question is, do we offer closing cost assistance programs, down payment assistance programs? We don't. Those programs are typically offered by the state of Maryland through the Department of Housing and Community Development. So that would be the agency you'd want to talk to about any of those eligible programs.
And how about Harford County Public School employees?
Well, Sue, I'll let you address that one.
Well, I know that we do have special programs for the Harford County school employees and opportunities to save on in many ways, and one is to work with us on their mortgages. So yes, Harford County Public School employees should definitely consider contacting Freedom and getting information on their mortgage program. So I think we've covered most of our questions. It's nice for you all to know that when you do contact the mortgage department, you will actually be in touch with Mike and the folks that work with him. So you're going to work with a person that you now know and have met and have spent an hour and 10 minutes with already. So we welcome you to contact Mike if you have any further questions, and you can always email mortgage@freedomfcu.org. And with that, I just want to thank everyone. I don't know if Mike, Carmen, if you have any parting words of wisdom for all, but we really appreciated and enjoyed spending this time with you. We thank you for all of your questions. If we missed any, we have recorded this session. It will be posted, and we'll take a look at the questions. And as I said, please just email us or give us a call again for attending. And for those of you that are interested in college planning, we'll look forward to seeing you next month, April 21st. Have a great day, everybody.
Thank you.
Thank you, Mike.